Hi, my name is Elliott and I'm the editor of the Energy Strategist as well as Personal Finance. Today I want to talk a little bit about the energy sector in general and specifically in oil and natural gas prices and a couple of other energy subsectors I think are attractive right now. What we've seen in oil over the last 6 or 8 months is obviously oil prices bottomed out in late 2008 and early 2009 in the low 30s per barrel. They rallied all the way up to about the $73 or $74 level in late June, early July. Since then, they've pulled back very sharply and actually closed under 60 for a couple of days in July. Basically what's happening is the market's still responding mainly to demand. Last year, the reason oil prices dropped so sharply from their highs around 150 was concerns over the fact that the U.S. recession was causing oil demand to really fall off a cliff. U.S. oil demand collapsed at the fastest rate in history. Oil demand in a lot of other developed world countries like Europe also saw severe retrenchment. And even the developing countries, which had been the real engine for growth in oil demand, saw a slowing in growth and in some cases actually threw it into reverse a little bit. Basically that caused oil prices to come down very, very sharply. What's happened since that time is we've seen evidence, increasing evidence, of the U.S. economy stabilizing and probably likely to begin a recovery some point later on this year, probably end of this quarter, early in the fourth quarter. And as expectations for growth in the U.S. have improved, and more importantly, expectations for growth in the developing world, places like China have had very, very strong economic data this year. At the beginning of 2009, most economists were looking for China to grow sort of 4 or 5% this year. Now a lot of economists are expecting 7-8%. I actually think we could see 8% plus growth out of China in 2009, which is amazing considering how quickly their economy slowed last year. All of that spells much, much higher demand for crude oil and a stabilization in demand in the developing world, or developed world rather, and that should help to continue to support prices longer term. What's happened since June, July? We're seeing a classic correction in oil, something we've called for quite some time now in both Energy Strategist and in Personal Finance. The main catalyst for that is some sort of volatility that we're seeing in economic data. Obviously, there are literally hundreds of different data points on the U.S. economy and foreign economies released every single week. Even in the strongest recoveries, it's unlikely that all those indicators are going to point in the same direction at the same time. What we've seen is a few major reports, such as the employment report for the U.S. And some of the consumer confidence numbers that came out in early July, suggest that perhaps the U.S. economy isn't recovering as strongly as and as quickly as some had thought. Generally speaking, when it comes to economics, I tend to look at a few simple indicators. I think if you look at too many, you can drive yourself into sort of a paralysis situation. One that I write about and look at a lot is the leading economic indicators in the U.S. We saw 2 monthly gains in that index of more than 1%. That's the first time that has happened since the 1960s, actually since the late 1950s. And typically when that does happen, or when you get 2 large monthly readings in a row, that tends to suggest that the end of the recession is very near if it hasn't actually already occurred. As I mentioned earlier, I think it's going to occur about the third or early in the fourth quarter. And as a result, I do think that oil prices are going to find a low. My guess is that oil prices probably will find a bottom in the 55 to 57.50 region. Reason I highlight that region is simply that it's an area of major technical support, just looking at the charts. I think that'll probably form a nice low for oil prices this year. And I do expect, as we see more evidence of the U.S. economy recovering and the Chinese economy doing a lot better than expected, we will see oil prices over $80 by the end of this year. Next year, I think supply is going to become a lot more important issue. Essentially what we've seen is a real slowdown in investment as a result of those low oil prices over the last year. Supply is becoming a real problem outside of OPEC. The slowdown in supply, meaning resurgent demand, should bring us $100 oil again next year. That of course brings us to the question is, how do we profit from this? Most energy stocks have seen a pretty severe pullback over the last month, somewhere on the order of 20% or even a little bit more in some cases. Oil itself has pulled back. I think it's too late to go out there and aggressively short oil prices. I think you've missed the majority of that move. I think now is the time to start to look at what stocks can we buy ahead of the next run-up. One sector that I would highlight, and I've highlighted it before, is the oil services space. Specifically, one I like a lot is Weatherford International. The symbol is WFT. Weatherford and the other oil services companies provide very necessary services used in the production and exploration for oil and natural gas. As oil becomes harder to find and harder to produce, requires a lot more in the way of oil services. Weatherford is the fastest growing oil services stock in my coverage universe. It's one I recommend both in the energy strategist and in personal finance. Two other things to keep in mind about them: they have an excellent position in Mexico and Brazil, which are two markets which haven't slowed down much over the last year. Another thing is they just made a major purchase of TNK-BP's oil service subsidiary in Russia. Russia is a market that got crushed last year and is actually picking up quite a bit this year, and I think that's going to be a major asset for them as the oil market and exploration activity re-strengthens again into 2010. Thank you very much.